Let's bring in Hans Olsen. He is head of America's investment strategy at Barclays Wealth with about $272 billion. Did I say that right? Yes, $272 billion under management. Hans, great to have you. Cherry picking, where do you make the most amount of money in 2012?
In 2012, I think it's large cap space, primarily, Adam. Large cap names with dividend payers. Because if we're in another year where economic growth is pretty tepid and you can't rely on the market to sort of re-rate valuations on equities, getting paid to wait makes a great deal of sense. And so large cap names that are trading essentially a standard deviation below their long-term average, plus getting paid a yield, which compensates you to wait, is the way to go. And in fact, that has been the way to make money this year. It's been pretty remarkable that way.
Yeah, the dividend ETFs actually are up almost double digits versus the market, which is down 1%.
Yeah, I mean the dividend. If you look at the Dow dividends, they're up over 10% compared to the S&P, which is essentially flat. And you got that 10 times return with about 80% of the volatility. That's a great risk-adjusted return.
Hans, maybe you can riddle this for me, because we have had countless guests on. Well, I'm exaggerating a little bit, but a number of guests on.
I know where you're going, and you're right. There have been a lot of them.
Because you know what? My contraindicator tendencies tell me that when so many people are saying you should be buying large cap, high-yielding stocks, that's exactly where I shouldn't be investing. I mean, how do you fight that? And I know every investor has that natural urge. They don't want to move with the pack necessarily, but you're all saying the same thing.
It is singularly the most unsexy investment idea that's out there.
You're an honest man, huh?
I applaud your honesty.
But it is, the numbers really support it. And again, what is different about these types of companies is, and we went back and we looked at this based on a 10-year average. We looked at it price to sales, price to book value, price to cash flow, and this sector of the market is uniquely undervalued.
Compare it, though, to some of the other sectors, right? We've been talking about small caps. We just had the Stock Traders Almanac on here, making the case for small caps. Why not small caps? They usually are the higher beta stocks out there, which means they should have been punished more than the large cap stocks this year.
Yeah, you would have thought. And actually, about a week ago, I went back thinking that to see if there was an opportunity there. And what I found was, from a valuation perspective, it sat right on its 10-year average, number one. And number two, it as of yesterday, or actually as of earlier today, it had performed better than the large cap space. So not much better, but better than the large cap space if you compare the S&P small cap to the large cap. And so when you put those two together, one, it hasn't been beaten up, and two, the valuations are just average. It's sort of fairly valued. It's hard to get terribly excited about it.
How about high yield bonds? There are some decent returns there, 6, 7, 7.5%. Does that strike your fancy?
Yeah, it sure does. It strikes me as one of those markets that are impaired, right? Whether it be high yield bonds or loans, what you're doing is you're seeing prices that reflect default rates that we don't think are going to come to pass, because the corporate balance sheets are in much healthier shape than they have been over the last several years.
We were talking about Peter Scher's call on this whole ECB decision today and whether it helps liquidity in Europe. Obviously it does. He also says you're shoring up the balance sheets of some of the European banks. He wants to start buying those. He's nibbling. Would you consider buying any of the European banks?
No, not yet.
Still too much hair.
It's still too much hair, and I think this was a short-term fix to a long-term problem, and it's the beginning of this deleveraging and restructuring of the European banking sector is going to take some time. How I would play that is buying distressed debt off the banks. Off these European bank balance sheets. I wouldn't want to be an equity owner.
Are you
but
saying
if I could be
the
secured,
debt of the banks or the debt that they own that they need to unload to shrink their balance sheet?
The loans that they have that they're going to need to unload, I'd be a buyer of that. But I'd be a buyer of that at cents on the dollar, which is where you can do it.
And when you say cents on the dollar, 40 cents, 30 cents, 10 cents?
Somewhere between 40 and 60 cents on the dollar.
Cheap value.
It's a haircut.
I want to get a little psychological here, right? Let's talk about behavioral finance, because there is no better market to illustrate sort of the psychotic, I think, tendencies we've seen lately than today. If you look at, we had stock futures rallying quite significantly, then we faded, and then we kind of came back right here at the close. How do you explain that to your clients? You're working with extraordinarily wealthy clients at this point. Is there a tendency to go, you know what, just get out, I can't take it anymore?
No, I mean, our counsel to them has been to stay engaged, but to make sure that you're getting paid for the risk that you take. I mean, some of the behaviors that investors engage in are rather heuristic, right? They do things that they think in their best interest, but invariably are not. And sort of binary moves in and out of the market are typically not the way to do it. But getting paid for the risk that you take, or getting paid more than the risk that you're taking, I think is the hallmark of really successful investing. What we've been trying to do is to find those pockets where that risk-return opportunity sits and exploit it. Because we're in an environment right now where, despite all the money that's been printed, there is a shortage of investable capital. And so if you have capital, you set the price, and if you set the price, you set the return. We want to be in those spots where the market is either dislocated, broken, or somehow not functioning correctly. If we can do that, we can get a better risk return.
And for now, you buy the large cap dividend paying stocks because there's still so many clouds on the horizon.
In the U.S. market, yes.
Okay, Hans Olsen, who runs the strategies for high net worth individuals at Barclays, $272 billion under management. That is a large number. All right.